Welcome back to How to Invest, everyone. Today we're going to be talking about how to find which stocks to buy, how to build a story and conviction in a stock so that in market turbulence you have no fear and can buy all the dips, and then also have the conviction to hold for the long term, which is how you get the biggest gains. So I am here. We're doing this in a conversational format. This is episode number 2 of How to Invest for Beginners of 7. This is my sister Abigail. How about you say hi?
Hi.
So yeah, she is new to investing. So we thought that one fun way to maybe do this series would be to have me actually teaching her to make this more conversational. Plus, I think it changes the vibe as I'm talking to my sister. And teaching one of my family members, way different than talking to a camera. And I want you guys to get the same advice that I would literally give to my siblings. So that's what we're doing here. So a little bit of background on myself, just so you know. I learned investing from Peter Lynch. He was my mentor in investing, I would say. He's written a lot of really great books about how to invest and was one of the greatest professional investors of the last couple hundred years. He even had higher returns than Warren Buffett, so pretty good. And since learning from him, I have averaged the last 5 years over 70% annualized returns in the stock market, and the last 2 years over 100%. And yeah, I love stocks. I research stocks all the time. It's just so cool seeing what companies are changing the future. So in this video, this is quite easy, honestly. Like, if you get anything out of this video, I want it to be the confidence to know that you can literally find great investments. Investing is not something that's just for professional money managers. It's not for these people just on Wall Street. It's literally for everyone who wants to put in a little bit of time and own a part of the economy that they're participating in. So what would you say as a beginner, just guessing, and I guess you've heard me talking before, what's a good way in your opinion, to find a good stock to invest or to find a good investment?
I know one thing that you've talked about is a really good CEO, someone that has a vision for where the company not only is, but where they're going.
Yeah.
Yeah.
For sure. Definitely the leadership of a company is really, really important. And having confidence in the leadership, that's one of the most important things, because like if you have an incredible CEO that really understands the company, really understands the industry, and really knows how to create value, it like doesn't matter what happens in the world, they're going to be able to pivot, they're going to be able to figure it out. And as an investor, you don't have to know everything. You just have to trust the leadership that you're buying into, that they understand how to navigate it. So yeah, that's definitely one of the core pillars that I look at, and one of the core things that just make me sleep well at night in my stocks, in my portfolio, is just knowing they have really great CEOs. I personally love founders, but let's take a step back here and just talk about like how to just discover a stock.
Yeah, I don't know if I know how to discover a stock.
So it's one thing Peter Lynch actually talks about a lot. Literally just the products that you like can be a great way to get introduced to a company. For example, like a lot of people, when the iPhone came out or even the iPod, really liked that product. They thought it was really cool. That would have been a great way to find an incredible company. And all a company is the value that they generate selling their product. So finding a really good product is one of the very first core parts of investing. And Peter Lynch actually found a lot of his best investments while he was managing billions of dollars in Fidelity from his wife going to the store and being like, I really like these leggings.
So you're saying you don't just go to whatever product is super gimmicky at the time, but just
something
things
you
that
really
actually
like.
provide value.
If all of your friends are going to a new body shop or something, like for lotions and smelly soaps and
like
stuff.
Bed Bath and Beyond. Yeah. Bath and Body Works. Okay.
Sure. Yeah. Like that can tell you, that's really hype. I wonder what they sell, and then that can literally be the starting point to start researching into a company. Now that's not the end, and this is where a lot of people get it wrong, and we mentioned this on the first video, is you just hear about something and you're like, oh, let's buy it. But like you have to understand the story. So like one of the first things that you'll need to figure out if you really like a product is, well, how much can this actually impact the company that's selling it? Because there's a lot of companies that are like super, super big. For example, if you buy like a fast food brand, sometimes a fast food brand can own multiple fast food brands, like
Chains,
multiple different chains. Burger King, for example, they might own Burger King and Tim Hortons. I think there is a company that actually does own both. And you might be like, oh, wow, Tim Hortons is opening up in all these places, and buy the stock, not understanding that, wait, Burger King is actually a much bigger percentage of that company's revenue, and Burger King's been struggling and shrinking, and you buy the stock and the company's revenue goes down, you're like, but I'm seeing all these new Tim Hortons. It's because you have to understand, okay, what percentage of the revenue is this product? So that gets into the second thing. After you actually find a product you really like, well, look into how the company's actually doing, what their revenue streams are. And guys, this is not that hard. Like, this is not as impossible as it sounds.
It's all public knowledge.
Yeah, it's all public knowledge. You might be able to find some YouTubers talking that do a good breakdown. If you just want to watch YouTube, you can literally find earnings calls for most companies on YouTube as well. You can
It's just fake.
you can literally listen to analysts asking the company questions, and you can learn a lot about how the company works. And then it's also really important when you're building a story to look at the balance sheet. And you can find that on the investor relations page. You can find that on Yahoo Finance. All this stuff is public for public companies. You can literally see it all. So you can know, oh, wow, this company has a lot of debt. And that will help, like literally doing a little bit of legwork like that can help you avoid a ton of really big investing mistakes.
And feeling scared away from investing as a whole.
Yeah.
Because you lose a little money because you didn't dive deep.
Exactly. So I have found quite a few like very compelling stories. So let me describe a couple stories that I found to give you guys an idea of like what I'm looking for, what I think are good investments. So one that played out was obviously Tesla. And it was really simple. One of the things that I was looking at that helped me, I won't go too much into it. If you've watched the long video, you already know this. But one of the things that helped me to realize that this company was about to turn to profitability back in like 2019, 2020, was the fact that battery costs, which were the largest costs of manufacturing an electric vehicle, were dropping every single year. And you could just see, wait, their cost of goods is going down every single year because the biggest component with the biggest cost is dropping every single year. So many people were betting against them as eventually going to go, as like they're going to go bankrupt because they were losing money. But you could just chart battery costs and see, wait, they're about to become profitable. They're about to start making money on every sale instead of losing money on every sale, which is a really big change.
Yeah.
So just doing a little bit of research and creating that very simple story. You don't have to be super smart. You just have to understand, like you have to have some common sense and understand some things. And that
it's not about just understanding some things. It's understanding particular things. You need to, there's a list that you literally, I know when our brother Aaron, he's like, I really like this stock, Jake. And you say, okay, so what's this, and this, and you have a list of things that are important to look at when you're about to invest in something, right?
Yeah, exactly. And we are creating a course that's like going to go super in depth on, and we'll probably even make more videos about it publicly as well, but on literally the analyst sheet that I have for my siblings when I want them to do research on a stock for me so that I can build the story. And we'll go over all of that and really help you guys build the story. But let me talk about another example. So that was just literally one simple thing. You didn't have to know anything complex. You just had to know, hey, wait, it's getting cheaper for them to build their product and they can just keep selling for the same price and they're going to start making money. Mm-hmm. And that's a massive change. So another, I think, really simple thing is a bet that I'm making that hasn't fully played out yet. But Lemonade for Insurance, it's an AI insurance company. And it just seems really obvious to me because I've played around, obviously, I think most of you guys have probably played around with ChatGPT and other AI chatbots. But AI agents are literally able to be trained to do pretty much anything on the computer. And and AI can literally learn risk assessment for deciding what the premium is going to be on an insurance policy. AI can do customer support, and if it's all built from AI, that the AI is not frustrating to deal with because it can actually make changes for you. It can actually tell you all the information that you need.
It has access to everything that a real person would, which is what makes AI so frustrating when they're like, "Sorry, can't help you."
Exactly. So once again, it's a really simple thing. I think insurance is probably one of the first industries that's going to be able to be almost fully automated. Just because the product they're selling is just a promise, and the AI can do everything that's needed to make the product, and there's no physical part of it. So the simple part of it, though, is really simple economics. Wait, Lemonade is going to be able to have way more customers per employee than current insurance companies have, which means their costs of goods, once again, are going to be way lower than everyone else, which means they're going to be able to charge you less for your policy. They're going to be able to have more profit for the owners. And if you can undercharge, they're going to be able to still market share. But then with AI, they're also going to have better data and risk assessment. So they're going to have lower loss ratios. And it's just like all this stuff, but just on a very simple, basic level, if it costs Progressive like $200 of employee costs for your $1,000 portfolio or for your $1,000 policy, and it costs Lemonade only $50, 1/4 of employee costs for your $1,000 policy, it means they can give you a $100 discount, so it's now only a $900 policy.
So it's better.
And they make an extra $50 as well because they have less cost.
It was beneficial for not only the company and the investors, but it's actually beneficial for the people receiving the insurance.
Exactly. So if you can find something that's changing and you just get a simple story built, like all you really need is a simple story like that. So why am I invested in Lemonade? Because they're much lower cost, and that's going to allow them to be more competitive in the future. And I think they're going to get a lot of market share in a big market. And they're a small company. And you can literally, I love Peter Lynch. He says, in order to be a good investor, you have to be able to describe why you bought a stock in crayon in a way that a 6-year-old can understand. And I was like, yeah, that's like a really, you don't have to be overwhelmed by this.
Yeah.
And one way I love to get ideas to start building my story is I watch a ton of stock YouTubers like you guys are doing now. I'm sure you guys watch a few as well. But they can help give you ideas, but then you have to develop the story yourself. You have to understand it yourself. So we talked about a couple things: really good product, understanding their actual financials, where their revenue is coming from, how much it's growing, are they profitable or not. Profitable companies are way safer, by the way, way less likely to go bankrupt. Understanding their cash position. Oftentimes you can find companies that have like a ton of cash and hardly any debt, and they can sometimes be so cheap that you're almost buying them for their cash value. There's crazy market periods like that where you realizing, well, I get this company almost for free. But you have to develop that story. Robinhood was literally selling for less than the cash that they had on hand in the 2022 crash that just happened a couple of years ago. And since then it's like 5x or something. So there can be a lot of opportunity if you develop the story. So understanding the fundamental stuff, understanding the leadership. And then just keep learning. Don't be afraid to continue learning both about the company that you like and start buying, because as you learn more, your conviction is going to grow, which is going to allow you to add more. Or maybe you'll realize you were wrong. That happens a lot. So when developing the story, that's kind of one tip I would give you, is be okay being wrong and changing your opinion if the facts, you realize you misunderstood them, or if the facts change. Some part of being a good investor is if a story changes and you realize you were wrong, selling out right away. Don't worry, I'm down 30%, I want to lose money. Let me wait for it to bounce back. If you're wrong about the story, then time's no longer, your friend.
Yeah. That totally makes sense. Okay,
any thoughts about building the story, or was all that clear?
I think all of that was pretty clear. I mean, it's just really about actually knowing how the company is doing what they believe in, and if that's going to be beneficial not only to them but to people down the line.
Yeah, one thing I would warn you guys about when building your story is Peter Lynch says that the dumb money is only dumb when it listens to the smart money.
What do you mean by that?
On CNBC, which is stock news, They will talk all fearful when stuff's down and tell you to sell in the very moment that you should be buying. Or when things are really expensive and overvalued, they'll be super hyped and talk about how the market is so good.
Well, what's the benefit of them doing that?
Well, so depending on who it is, sometimes they might have just like, they might be short the market. So they're telling you to, sell. They've been making money betting against the market when it's going down, so they want to keep it going. Or maybe they're trying to push a price down so they can buy something. Who knows? Like, people can have so many reasons. I'm sure there's people on CNBC too that really do want to give their honest opinion and advice and help people. But really, your dumb money if you're making your investment decisions based off of someone else's advice. Like, you don't understand the thing enough. Like, the moment you understand the thing enough to not listen to someone else, you're no longer dumb money. As Wall Street would call you. You're not, even though they'll call you.
You're no longer gambling. You are making an educated decision rather than just saying, oh, well, that person said it, so I guess probably they may be right.
Yeah.
But if you don't know them and trust them.
Okay, so then the last thing we'll talk about in this video, which is really important, is the valuation. And valuation is honestly one of the things that gets me really excited about a lot of companies. Like, I like after a stock has dropped a ton.
Okay.
So valuation is the price that you're paying for it compared to its current earnings and revenue.
Okay.
And then there's like a lot of multiples you can look at, which is like, it's the multiple that you're paying for the stock, the multiple of book value. So the multiple of book value, for example, would be if a company has $1 billion in cash and no debt, and that's all they have, so they don't have any equipment or buildings. So if they just had cash, and it was $1 billion in cash, and you could buy the whole company for $1 billion, then you'd be buying it for a book value of 1.
Okay.
So you're paying 1 times the value that they have on their book, which is exactly what the value is. And if it was split into shares, like maybe there would be 1 billion shares of the company worth $1 billion. So you can buy a share for $1, but you add all the shares together.
For $1 billion.
Exactly. You're paying 1 time book. So for a lot of companies like banks and stuff, you'll pay like 2 times book value, stuff like that. A lot of tech companies, you might pay a ton times book value because they just have so much earnings power, but hardly any assets because they're asset light.
They're usually like, just because they only have that much cash, their company as a whole is worth double the cash that they have or something.
Yeah. So when you calculate book value, you look at everything. So you look at their value of the offices they own. They might even throw in like the value of some of the brand that they have. Like Disney might say Mickey Mouse is worth this much intangible value. They might add that to their book. So it's important to actually look through a balance sheet. Well, we'll do whole videos on this channel about how to read a balance sheet. But yeah, so that's one multiple. So one of the most important multiples is price to earnings.
Cool.
So that's how much you're paying compared to their earnings. So one way to think about this, we'll make it per share to make it easy. So if a company is earning $1 per share and each share costs $10, then you do 10 divided by 1, so you're paying 10 times earnings.
Gotcha.
Because, the share is worth $1 and it's making $10. Does that make sense? So it will take 10 years before your asset fully earns what you paid for it. And then you still own it, so if you paid 10 times earnings and it just stayed at 10p and you owned it for 10 years and made all of its money back, you are going to get the value as an owner somehow. So it can either be through dividends, they'll pay the dividends back to you and they'll literally just give you the cash that they're earning. Yeah. In other ways, they might buy back stock. Okay. So they'll literally remove stock, so then the stock you own becomes a bigger and bigger percentage of the company. So they take their earnings and they give it back to you by growing your ownership of the company, which then means you're getting more earnings because that's the same dollar amount of earnings getting divided between less shares. Yeah. Another way that you might get the money back is that they reinvest it into more growth. So you might buy it for 10 times earnings now, but in 10 years from now, their earnings might be doubled or tripled, which means that not only did you earn back your full amount, but now you're earning like 1/3 the amount that you paid. It's only taking 3 years for them to earn the full amount that you paid. Warren Buffett he bought Coke so long ago, Coca-Cola stock, that in dividends, they now pay almost the same amount every single year that he put into the stock.
Wow.
So not only has the stock gone up a ton, but he's literally getting billions of dollars of cash just paid to him every single year that is worth the same as his initial investment.
Which would kind of be an argument for just leave your money in the stock market.
Yeah. But it's important to understand what you're paying. So for valuations, when you're building your story, Peter Lynch says that it's not good to pay more than the growth rate in a PE. So if a stock is growing 30% a year, then you don't want to pay more than 30 times forward earnings, which is like the expected next year's earnings.
Okay.
Because if you pay too much, then companies have to grow a ton in order for it to be worth it. So like we really like Tesla, but Tesla is not cheap because it's trading like 140 times earnings or something, which is 140 years worth of last year's earnings. That means that in your whole life of owning it, if they didn't grow earnings at all, you would never earn back your investment. Does that make sense? Mm-hmm. So you're making a super small amount. So why would people pay so much for Tesla?
Because it's about the future of the company, not just the right now.
Yeah, because people are expecting Tesla's going to be able to grow their earnings a ton. And if Tesla 10x's its earnings in the next 10 years, then instead of paying 140 times earnings, you're actually paying 14 times 2035 earnings, if that makes sense.
Yeah, kind of.
And as they keep growing from there, people are expecting 20 years from now, maybe it will be like Coke. And they're actually just earning the amount I'm paying now every single year. Like maybe Tesla's earning $700 billion a year or something because the Optimus spot's out. But when you pay a big multiple, it's a lot more risk. Mm-hmm. So that's part of developing the story.
Because there's a lot more opportunity when the company is small for it to get bigger.
Yeah.
But once you get so big, it's hard to continue just getting bigger.
That's true. But then also the amount that they have to grow for it to come back to fair value is a lot more when it has a big multiple. A small company can have a massive multiple and a big company can have a massive multiple because it's about how much you're paying for it compared to how much they're earning. Mm-hmm. So if a company's only earning $100 and you're paying $10,000 for it, even though it's only a $10,000 company, it's super small. Because they're only earning $100, you're paying, what is that, 100 multiple? 100 times earnings, 10,000 of 100. So you can pay a big multiple on it, even if it's small. But you're right. A small company can grow a lot more. We'll talk about that, I think, in the next story, which is stock categories, which is going to tell you about different sorts of stocks. So hopefully you guys enjoyed this video. If you did, make sure to drop a big thumbs up and subscribe if you're not subscribed already.
Click the bell.
Yeah, click the bell icon, and we'll see you next time. Bye.